Order blocks are a great way to track the footprints of institutions. But sometimes by using order blocks you face more losses than profits. This is because using order blocks on their own is not very effective. Instead, you should use a high probability confluence. And this is exactly what we are going to discuss in this video. Before we dive into the strategy, let's first understand order blocks in depth. Order blocks are specific price zones where large institutional traders like banks or hedge funds place their significant buy or sell orders. These orders create powerful support or resistance levels that can drive price movements when revisited. For example, a bullish order block is created when a group of buyers places their orders in a specific price range, like in this image. When the price revisits that zone, it often leads to an upward price movement as the orders get filled. Conversely, a bearish order block is formed when sellers dominate the market, creating resistance at a particular price level that tends to push the price downward upon a revisit. You probably already knew what we discussed till now. But now, let's get towards what you are really here for: the powerful combination of order blocks and market structure. A break of structure happens when the price moves beyond a significant previous price level, either a swing high in an uptrend or a swing low in a downtrend. This indicates a shift in market direction and suggests the potential continuation of the current trend. For example, if the price breaks above a previous high in an uptrend, it's a sign of bullish momentum. Similarly, if the price breaks below a previous low in a downtrend, it signals that bearish control is in play. Our two consecutive break of structures strategy takes the concept of BOS to the next level. This strategy focuses on the idea that when two consecutive breaks of structure occur, they create a stronger and more reliable order block. The way it works is that when the price first breaks a swing high, it makes the first break of structure, and then when it breaks a higher high again, a second break of structure is formed. The area between these two highs forms a support zone. Conversely, when the price first breaks a swing low, forming a first break of structure, and then breaks an even lower low, a second break of structure is formed. The area between these two lows forms a resistance zone. By waiting for the consecutive breaks, we confirm that the market has a strong momentum shift. Now let's break down how to trade this setup effectively. The first thing you need to do is identify the order block by marking the price zone formed after the two consecutive breaks of structures. Once the order block is identified, we will place a buy limit order at the high of the zone and stop loss at the low. The next step is to wait for a pullback. Similarly, for bearish setups, after two consecutive breaks of structures, we should mark the formation of bearish order blocks. After that, place a sell limit at the low and stop loss at the high of the zone. When the price climbs up to the zone and picks up the limit orders, our order will also be executed. After that, we can take profit at our desired risk-to-reward ratio. Let's look at a practical example to see how this works in action. Here we have a EUR/USD chart on the screen. We can see the price forms the first break of structure and then makes another break of structure. This clearly indicates a huge bullish sentiment in the market. So, we are in a good position to trade bullish order blocks. After these two consecutive breaks of structure, when we see the formation of a bullish order block, we should mark that area. The bullish order block forms when there is a bearish candle, and then for the 5 consecutive bullish candles. After marking the zone, we should immediately place our buy limit order at the high of the zone and a stop loss at the low. Now, when the price comes back to the zone and moves upward after executing the orders, we can decide our take profit. I would highly recommend setting a break-even point for your trade at a 1-to-1 risk-to-reward ratio and a take profit target at a 1-to-2 risk-to-reward ratio. Also, for better risk management, you should never risk more than 2% of your account on a single trade. Now, let's look at how to trade a bearish order block setups. Here we have GBP/JPY chart. First, we have to identify an initial break of market structure, which is then confirmed by a second break. This sequence of lower lows and lower highs indicates significant bearish pressure, making bearish order blocks high probability trading opportunities. Once these breaks are observed and a bearish order block forms, we should mark out the order block zone. Then place a sell limit order at the low of this zone and set your stop loss order just above the high. As price retraces to the order block and activates your sell order, you can then plan your exit strategy. Consider moving your stop loss to break even once price has moved in your favor by an amount equal to your initial risk 1-to-1 risk to reward. And similar to bullish trades, aim to take profit when the trade reaches 1-to-2 risk to reward ratio. To make the implementation of this strategy even easier, I'm also working on our order block indicator update as well. This update will highlight order blocks formed only after two consecutive breaks of structures. The indicator will automatically scan the market in real time for these key setups and mark the corresponding order block zones. This tool will save you time by eliminating the need for manual chart analysis, and it will allow you to focus on high probability trades.